Friends, in this video for I Thought Wealth, I'm going to talk to you on this topic. Should you stop investing now? Many people ask this question, should I stop my SIP? Should I take out the money because the index is at an all-time high? Should I wait for the right time to start investing? What I have seen with people who are always trying to time the market or time their actions is that they completely miss out on their investing responsibilities. Now, let's say that this person actually stops his SIP. What does he do with the money? He mostly wrongly allocates it or misspends the money. The money doesn't last. It's not there. So, saying that now markets are high, therefore I'll stop my SIP, I'll do it later, I'll put this money later, is easy on paper, but in practice, what people bring into their life is indiscipline. And what does it replace? It replaces what they believe is not efficient investing. So, in the name of being efficient, you become extremely inefficient because you fail to do what you originally agreed to do, which is invest regularly every month. Those who say that I will time the market at the right time. Now markets are high, so I won't invest. Do they actually keep the money aside and then invest it correctly when the markets come down? Or do they wait for too long, waiting so long that the markets have not only come down but again gone up? This is another thing that I've seen with most investors, especially on the retail side. They want to be more efficient than what they can be. So they try to do something which they are not prepared to do, and they fail in doing even what is basic by claiming to do what is complex. Somebody who says, I will time the market correctly, tends to completely miss out, which again works against his own basic investment needs. So this is something that people should make sure doesn't affect their investing. So if you're going to stop something, the alternative to what you think is not efficient has to be more efficient, not inefficient. So that is where I think that investors have sorely failed. Instead, assume people continued investing every month without fail. They just changed their investments a little bit so that the SIP went into a lower risk product, and the higher risk product which they already invested continued to remain with them. The money in the lower risk product would always be available for them to invest later into a higher risk product. If you feel markets are trading at a very high valuation, which product should you stop investing into? That is again a question for which most people don't know the answers. Let's say you are doing an SIP in a large cap fund, a mid cap fund and a small cap fund. Which SIP will you stop now? And where will you deploy that money every month? Because you must maintain the discipline of deployment. Poll most people and they would say they will stop the large cap and run the small cap and the mid cap. But time could well prove that this choice is wrong. And the market may actually invert this theory on its head. So not only people would have stopped the right investment, they would have continued in the wrong investment. That possibility is very much there before us right now. So this business of stopping your investing lends indiscipline into your life, takes away the efficiency that already exists, which ideally could be better, but at least is there to the extent it exists, and makes you fail at fulfilling your investment duties. So stopping as an idea is not a great idea for most investors. It probably is a good idea for investors who are very evolved, very meticulous, very rigorous, and very transaction centric. Somebody who can focus on the transaction a lot and ensure that they don't fail to transact at the right time. So, such a person has to have all the time in the world to do this. Somebody who is busy in other walks of life, in professions, running businesses, traveling, doing other things, may not have the same astuteness and sharpness that is required to bring the desired efficiency. A regular investment is probably more efficient than all the smarts he can bring to the table. This is what applies to the average investor, and most investors will find this simple, straightforward, and easy to practice. And that, in essence, is what you should choose over what is complex, difficult to execute, and impossible to sustain. Thank you for watching this video.